Welcome back. In this video, we are going to define what is a stock and what is a stock market. We are also going to look at who all participate in the stock market. A stock or a share represents a fixed percentage ownership in a company or business. For example, if a company has issued 100 shares and if you own one share, then you have 1% ownership in the company. What this means is that you own 1% of net assets of the company. You also have the right to 1% of the net profit of the company. Now that we have defined what is a stock, let's define what is a stock market. A stock market is a marketplace for stocks where willing buyers and sellers of stock come together to trade with each other. This trading may happen either on a stock exchange, where the exchange manages the risk of trading, or the trading may happen privately between two willing parties. Stock exchange is essentially a platform or a network of computers where buyers and sellers transact in any security. We will cover stock exchanges in greater detail in a later lecture, but if two parties decide to privately trade a stock that is listed on exchange, then they are obliged to register their trade with the exchange. For the purpose of this course, we are limiting ourselves to stock trading on exchanges. When it comes to stock market and stock exchanges, the trading of stock may happen either in the primary market or in the secondary market. We cover this topic in detail in later lectures. For now, let's look at who all participate in the stock market. The various participants in the stock market can be broadly divided into two categories based on the quantum of their investment and also the complexity of their investment strategy. The first participant we look at is the retail investor. These are individuals who have surplus savings in their personal account. They either trade based on their own analysis or on the basis of recommendations from financial intermediaries like stockbrokers or research analysts. They usually do not follow a complex investment strategy. Also, the quantum of investment made by any single retail investor is very low when compared to institutional investors. The next participant is the institutional investor. Institutional investors are institutions like corporate, banks, government organizations, mutual funds, insurance companies, and pension funds. They are considered to have specialized knowledge and skills in investing. Often they do a lot of independent research before making any investment. They may also frequently deploy complex investment strategies and try to achieve superior returns using derivatives. The quantum of investments made by institutional investors is large. This is because they have access to large amount of capital as they pool financial resources from many individuals or entities. For example, mutual funds collect money from a wide range of individuals in order to manage it in accordance with a particular investment objective. Similarly, insurance companies collect insurance premiums from a diversified group of individuals in order to provide insurance cover. Their corpus is made out of these premiums. This corpus has to be managed so as to meet future insurance claims. Institutional investors often employ fund managers with considerable experience to manage the huge corpus. These managers are supported by a dedicated team of research analysts and traders who devote their entire time to this activity of investing. Hence, institutional investors often deploy complex investment strategies and achieve superior returns.